Howdy, howdy, howdy. Welcome to Let's Just Invest Part 2. Hopefully you have had time to watch Part 1 already, because today we will continue on our path to creating wealth for ourselves. Part 1 provided some terms and indicators to help you select some solid dividend-paying stocks, and today we will discuss some options of where to put those earnings, along with a few strategies to use as you continue to grow your wealth. Today we will go over 4 types of accounts that you may have heard of, but maybe just not sure about what they are or how they work. But no worries, I'm here to help with that. I will provide highlights to these accounts, but make sure to do your due diligence to ensure that you know all the details regarding the account you plan to use and how it fits your particular situation. We will then discuss these 3 things that I feel are important for you to know about as you research the stocks and funds that you're interested in. From there, I will share with you 3 popular investment strategies that most, if not all, investors utilize. And then finally, we will finish up with the next steps before concluding this series with Part 3. But for now, let's get to the Part 2. The first type of account we will cover today is the taxable account. This account is very similar to your average checking and savings account in that you can deposit and withdraw funds whenever you want without penalty for any of your cash balances. Keep in mind you will have to pay taxes upon the withdrawal of any realized gains after selling any stocks or funds from this type of account. This is why when setting up your brokerage account, it will ask you for your social security number and other personal information. I will go into more detail about that in Part 3 of this series. The amount of taxes will also vary, which will be covered in a later slide in this presentation. One of the main attractions about this type of account is that there are no contribution limits. You can add and add and add monies to this account until your heart is content. It's definitely the most flexible of the accounts being covered here today. Because of that flexibility, this is the ideal account to use if you determine that you will need to use some of the money before retirement. I only caution you to be careful not to make any unnecessary withdrawals simply because you can. Building wealth takes a measure of discipline that you and I both have, so let's just exhibit that discipline when making withdrawal decisions. Up next, we have the traditional IRA. IRA stands for Individual Retirement Account. As you can probably surmise from the name, this is a type of long-term investment account. This particular account takes contributions on a pre-tax basis, meaning the amount that you contribute is put into your retirement account before taxes have been taken out of your paycheck. So an important thing to remember when reviewing your statements is that this money has not been taxed, and it will not be until you make a withdrawal. It will be taxed at the current rate of income at the time of withdrawal. So if you're making more money right now than you anticipate that you will make when it's time to retire, this is probably the account for you. Currently, the limit for 2020 is set at $6,000 or $7,000 if over the age of 50. The additional $1,000 is referred to as a catch-up contribution, and it's designed to help individuals add more funds as they are closer to the age of retirement. While this is helpful to many, it is still a good idea to begin sooner rather than later because time is your most valuable asset when investing. With a traditional IRA, you have what are called required minimum distributions or RMDs. This means that at the age of 70 and a half, you are required to start withdrawing monies, no ifs, ands, or buts. Withdrawing money from a traditional IRA before the age of 59 and a half, you will not only pay taxes, but you will also get hit with a 10% early withdrawal penalty fee. With proper planning, you can avoid the penalties, but not the taxes. They're always going to get those taxes. Now, under certain specialized circumstances like first-time home buyer or qualified hardships, you may be able to make withdrawals before retirement and without penalty. Again, make sure to do your due diligence before making these types of decisions. Now we come to the not-so-distant cousin to the traditional IRA, the Roth IRA. Now these accounts are similar, but with some noteworthy differences. The first being that the Roth adds your money on a post-tax basis, meaning your contributions are deposited to your account after your wages have been taxed. So upon withdrawal in retirement, what you see in your account is what you get. This account would be ideal if you plan to be in a higher tax bracket when it comes time to retire. This way you can still make other money with a side hustle or a second job and don't have to worry about your withdrawals being heavily taxed in those later years. The contribution limit for 2020 is the same as the traditional IRA at $6,000 and $7,000 if you're over the age of 50. Another difference is that there are no required minimum distributions, so that you are not forced to make any withdrawals at any time if you don't have the want or need to. Withdrawals are a tad bit more flexible in a Roth versus the traditional account. Contributions can be withdrawn at any time, tax-free and penalty-free, but are based off of what are called the order of contributions. This can get tricky, so you may need to consult a professional and do some more due diligence if you plan to make withdrawals before retirement. As far as the earnings go from those contributions, they can be withdrawn tax-free only after having the account for 5 years at a minimum and qualifying for an exception similar to the traditional IRA. So yes, there's more flexibility with the Roth IRA, but that also means more guidelines to adhere to. So in summary of IRAs, if you think you'll be in a higher tax bracket when you retire, a Roth IRA may be the better choice for you. You'll pay your taxes now at the lower rate and withdraw funds tax-free in a retirement when you're in a higher tax bracket. If you expect to be in a lower tax bracket during retirement, a traditional IRA might make the most financial sense, as you will reap the tax benefits now while in the higher tax bracket and pay taxes later at a lower rate. And the last type of account we will review today is the employer-based 401k. It is named after the section of the IRS tax code that governs it. Usually this type of account garners higher fees because of how the offered plans are negotiated by your employer in conjunction with the funds that are made available to you. This also means that you will likely have less investment options. Now, like the traditional IRA, this account takes contributions on a pre-tax basis. An advantage to the 401k, however, is that the contribution limits are much higher at $19,500 or $26,000 if over the age of 50. And also like the traditional IRA, you will be required to take required minimum distributions. Now, the RMDs for a 401k must begin by April 1st of the year following the year that you turn 72 or the year that you retire, whichever is later. So there is more time to accrue wealth if you are not in need of the funds at your retirement age. Another advantage to the 401k is that your capital gains are never taxed by the IRS, only the contributions upon withdrawal. Now, that's a good deal. Overall, 401k plans are most beneficial when your employer offers a match, which is a free money that I suggest you don't leave on the table. I recommend contributing at least a minimum of what your employer is matching. So if they are offering a match up to 3%, you should contribute at least 3% to capture that free money. Okay, next up are 3 quick tidbits to consider when doing your research. Up first is the prospectus. This is a formal document required by and filed with the Securities and Exchange Commission that provides any and all information you will need to know about a stock, bond, or fund you are interested in investing in. In all honesty, the prospectus can be a very daunting document, but all you really need to know is that this is where you can go to find details and specifics about a security should you have any questions beyond what the average stock quote shows. The prospectus is generally found on the company's website. Tidbit number 2 is the ultra important expense ratio. This is a calculation that is specific to things like the 401k accounts, mutual funds, and exchange traded funds, which are collections of multiple stocks rolled up into one account. The expense ratio is the annual fee charged to you, the shareholder, for managing the fund that you're investing in. Anytime there is an expense ratio, it means that someone is making decisions about what companies comprise a fund, such as adding, removing, or making changes to the list of companies inside of that fund. It is charged to cover management fees, administration fees, operating costs, and all other asset-based costs incurred by the fund. It is always expressed in the form of a percentage, and I highly recommend you avoid any expense ratios over 1%. There are plenty of choices below 1% and even some that are under 0.5%. I will share with you one of the low-cost funds that I invest in part 3. So that brings us to tidbit number 3, short-term versus long-term investing. Short-term investing is holding an asset for less than 1 year, and long-term is anything over a year. This is important because of the tax implications for each time frame. If you sell the asset before 1 year time frame, you are taxed at your ordinary income tax rate, such as when you file your annual taxes for your employment. If you hold on to that asset for more than a year, your tax rate will be either 0, 15, or 20%, depending on your taxable income and filing status. This is generally going to be lower than the short-term capital gain tax rates once they're calculated. The idea behind this is that the longer you hold in equity, the more risk you take on, and therefore you are rewarded via a tax break for your patience and loyalty. All right, thanks for hanging in there with me. We're almost to the finish line. Now we will quickly cover 3 popular investment strategies that I'm confident that all investors have utilized at some point or another. First up the bat is my personal favorite, buy and hold. This is a strategy just as it sounds. I select the stock using the guidance from part 1 of this series, and I just hold them in my portfolio and accumulate more and more shares. I don't sell any of the shares unless the reason that I bought the stock initially changes, such as a dividend cut, a bankruptcy, or something major happens with the company that alters my investing plan. The next strategy is very common amongst investors and is known as dollar cost averaging, or DCA. This is when you invest in a specific stock and with the same amount of money at the same interval consistently. The amount invested does not matter with this strategy, it's the consistency that makes the difference. So for example, let's say I get paid every 2 weeks. If I wanted to apply the DCA method as my strategy with a stock like AT&T, I would invest $30 every 2 weeks on payday in AT&T regardless of the share price. When you practice this strategy, you will be buying more shares of the stock when it is cheaper and less when it is expensive. The consistency of buying on the ebbs and flows of the share price keeps your investment more conservative and less susceptible to a market crash. This is one of the methods that take the guesswork and calculation out of the equation and allows you to set it and forget it. And rounding out our featured strategies is the index method. This is when you purchase shares of a fund that mirrors one of the indexes on Wall Street, such as the S&P 500 or the NASDAQ. The objective here is not to beat the market, but to stay right in line with said index, which usually holds its own in the overall market. This method is known as passive investing and is highly recommended for those new to investing and is another strategy that takes the guesswork out of investing while creating wealth with minimal effort. And again, I will be sharing a low-cost option in part 3 of this series. Okay, you've made it to the next steps for this presentation. Congratulations. Just a few more housekeeping tips and you will have made it 2/3 of your way to the path to wealth. The next thing I want you to do is to take some time to decide which account discussed today is right for you. Consider the following things when deciding. Do you anticipate on making more money now or in retirement? Does your employee offer a 401k plan, and if so, do they also offer matching of any amount? Will you need to make use of these investments before your retirement, or are they solely for your later years? These points are important in order to select the right investment vehicle to follow through with your plan. The next thing I want you to do is to compare the expense ratios if you are electing to go with any type of funds or a 401k account. Remember, I recommend always keeping that amount under 1%. Now, I bet you thought that I forgot that in part 1 I said that I would provide you with a 4th indicator for selecting stocks. Well, the good news is I didn't, and that indicator is going to be the earnings per share, or EPS. The EPS is a financial measurement that tells investors if a company is profitable or not. It is calculated by dividing the company's net profit by the total of outstanding shares for this company. If the EPS is 0 or negative, that means the company's earnings are also 0 or negative. When utilizing this metric, look for a number above 0. The higher the number, the more profitable the company. This metric can also be found on any stock quote where the PE ratio is found, the dividend percentage, and 52-week range information is also found. And the last thing that I want you to do is subscribe to my channel so you can be notified when part 3 is released and your path to wealth is solidified. Please like, comment, and feel free to ask me any questions at any time. In conclusion of this part 3 series, I will also disclose one large cap, middle cap, and small cap stock, as well as a low cost fund index for your consideration, all of which are parts of my portfolios. So I want to thank you once again for taking a few minutes out of your busy day to watch this presentation and continue on your path to wealth. Until part 3, let's be safe, let's be healthy, and let's just invest.